Peter and I are both tax attorneys. We work at Frost Law. And in non-pandemic times, we deal with tax controversy. So anytime there is a dispute between a person or a business and like the IRS or Comptroller of Maryland, we get involved and help our clients. Most of my clients are small businesses that are kind of on the bubble of viability. And when COVID hit, and same as Peter's, they were about to get wiped out because of how impactful that beginning part of the pandemic was. So we had to really dig deep into the CARES Act and PPP and ERC and FFCRA and all that stuff to kind of figure out how we can help them, make sure that they can stay afloat and to keep things going, keep the lights on. In doing that, we learned a lot about it and have been able to help not just our clients who are struggling businesses, but all kinds of businesses that are eligible for these credits and able to talk through some issues. And law firms are certainly eligible, and it's a pretty big credit. So we're excited to be able to help you, work through this.
All right. So I think we called this like, you got PPP, but what about ERC? And so just to take you back a little bit, so you sort of remember what all has come down the last couple of years. PPP was, of course, the big one that took all the air out of the room for a really long time. And that was the go-to credit that all of these employers were going to get. But, in addition to the Paycheck Protection Program, there was FFCRA, which is the Family's First Coronavirus Response Act. There were provisions in the CARE Act allowing for deferral of employment taxes. If you took advantage of those deferrals of the Social Security tax, the first payment was due in December. The second 50% is going to be due December 31st, 2022. There was, of course, the employee retention credit, but in the beginning with the CARES Act, you couldn't get both PPP and ERC. There was also a restaurant revitalization fund grant program. There was the Shuttered Venue Operators Grant. And even up until last December, there was the disaster loan, EIDL, economic injury disaster loan. So that's been sort of the COVID era programs. There's a whole bunch of other Maryland ones as well that were out there. But that's sort of the background to this. As I was saying, initially, you couldn't get both the employee retention credit and PPP. That was expressed in the language of the CARES Act, which was early 2020. Then came along the Taxpayer Certainty and Disaster Relief Act of 2020. That was December 27th, 2020. And that basically said, hey, just kidding. You actually can get the employee retention credit, even if you got PPP. We'll get into some details about what that looks like, but that opened it up. And it also extended ERC into 2021. And so it wasn't just 2020. Then in March, after the change in administration, there was the American Rescue Plan that actually extended ERC to the third and fourth quarters of 2021 and introduced the idea of a recovery startup business, which we'll get into. And then, just to keep everybody on their toes, November of 2021, Congress passed the Infrastructure Investment and Jobs Act, and they said, oh, just kidding again. You actually can't get it for the fourth quarter of 2021 unless you can.
We're in the fourth quarter.
The devil's in the details, yeah. Because we're presenting to, attorneys here and you guys are a sophisticated bunch. Here's the guidance. The guidance, has come out. The big one is Notice 2021-20, gives a ton of examples and is really the source for a lot of the stuff that we're talking about here. 23, 49, 65 sort of track to the subsequent legislation that came out to clarify some points with each of those pieces of legislation. Rev Proc 2021-33 is specific to treatment of the PPP loan forgiveness and how that works with ERC. And then just to lay down the last little bit of basics, what we're talking about here is claiming a credit on your Form 941. So you guys as employers or your clients as employers are filing Forms 941 quarterly. That's reporting on the wages that you've paid to your employees. It is then also self-assessing FICA taxes, which includes Social Security and Medicare, both the employee portion and the employer portion. So that's the background and how this credit works. It's the vehicle for how it works, and we'll get into some more specifics now.
So the employee retention credit was again originally in the CARES Act and started in 2020. So for 2020, an eligible employer was allowed a credit against applicable employment taxes equal to 50% of the qualified wages up to $10,000 for the entire year. For 2021, an eligible employer is allowed a credit against the employment taxes for each calendar quarter, an amount equal up to 70% of qualified wages up to $10,000 with respect to each employee for the calendar quarter for tax year 2021. So what does this mean? Assuming you're eligible, and we'll get into eligibility later, but the credit is for 2020, you can get up to $5,000 per employee. So in the beginning, PPP was about up to $20,000 per employee. So PPP was way better. No one was paying attention to ERC because if you could get PPP, why would you deal with this? A government credit that's going to take months and months to refund versus where you can go to a bank and get paid within a couple of weeks and get 20 grand per person. It wasn't until when Peter mentioned when they changed it and increased the credit to about $7,000, up to $7,000 per employee per calendar quarter for 2021, did people really start looking at it when you could use both programs together? So the most you can get per employee is $26,000 per employee if you are eligible for all of 2020 and 3/4 of 2021. A lot of money.
And just to clarify, I don't know what we did with this slide, but so it's a credit related to employment taxes, but it's based on wages you paid to your employees. So it's basically rewarding you as an employer for keeping your people paid during the pandemic. So we say $10,000, that's real wage. And the credit is computed based on the wages paid, but it's a refundable, meaning you can go past zero, back to you credit based on employment taxes. So it's a confusing vehicle. PPP, they built on top of the existing 7A program with the SBA and banks and all that kind of stuff. This one is rooted in Internal Revenue Code and the existing payroll structure. So it's a little bit wonky, but that's what's going on here.
So who's an eligible employer? An eligible employer is an employer which is carrying on a trade or business during the calendar quarter for which the credit is determined. And you have to qualify either through a gross receipts test or a suspension/partial suspension test. The gross receipts test is the easy one, right? Most people can look at their gross receipts for 2020 and 2019 and see if they went down and by how much. So for 2020, the gross receipts test was 50% of the gross receipts for the same quarter in calendar year 2019. So second quarter of 2020 is when most businesses had like the biggest dip. And you would compare it to 2019. If it went down 50%, you're eligible. Hooray. For 2021, part of this whole expansion of ERC, they also made it easier to get. So instead of a 50% decline, all you need is a 20% decline. And that 20% decline is from 2021 quarter compared to 2019. So again, second quarter of 2021 compared to second quarter of 2019. And if you're down 20%, you qualify. I actually had a CPA ask me this week, do those declines have to tie back to COVID? They do not. If your gross receipts reduced during this period of time, you're eligible. You don't have to give a reason. There are alternative reference points for 2021 that allow for automatic qualification for successive quarters. So if Q1 of 2021, you're down 20%, you actually automatically qualify for Q2 as well. When they increased it, they really did a good job and made sure that people could get it, for businesses.
And it tracked the same with PPP. They made it easier and easier. Forgiveness was easier and easier.
Yep.
Congress is doing the same thing here. They're making this credit easier and easier to qualify for.
And I mean, I think really when they were contemplating the CARES Act and what was going on in the country at the time, I think Congress really thought They were going to turn the economy off for 8 weeks, pay people for the 8 weeks, and then turn it back on, and everything was going to continue as it was. No one, or at least they, didn't contemplate, how long this pandemic was going to impact businesses, impact homes, impact families, schools, and all those things. And so as we kept going through it, if you remember in PPP, at first you had to use all the money within 8 weeks. And then it became 24 weeks. And then you could use it for different things. And, again, the same thing with the ERC. They really just expanded it to help businesses, continue during this time. Okay, so gross receipts. If you don't qualify for gross receipts, what if your gross receipts went up? What if you did better? Can you still qualify for ERC? Yes. Hooray. The next method is a full or partial suspension. So the way I explain this, and for lawyers is perfect, is eminent domain. The government took something from you, your way to operate your business. You can't do something that you were able to do before. Therefore, you should be compensated for it. So the operation of the trade or business is fully or partially suspended during the calendar quarter due to orders from an appropriate governmental authority limiting commerce, travel, or group meetings for commercial, social, religious, or other purposes due to the coronavirus disease 2019. So this suspension, these restrictions do tie back to COVID, and they tie back to a governmental order. People ask us all the time, well, my company followed the CDC guidance, so we weren't able to do X, Y, Z. Does that count? No, it does not. That is not a government order. That is following guidance. It's not the same thing as the government forbidding you from doing something. And we'll get into this way more in depth as far as how law firms are going to be able to qualify for this full or partial suspension. But this is the framework that it's in. It has to tie back to a government order, and it has to be limiting the way you do things. So an easy example for this is a restaurant. They weren't able to open their dining rooms, but they're able to still maintain takeout. I have some clients that absolutely crushed it using takeout. Revenue went up. Their dining rooms were closed. And then once they were opened at 50%, then 75%, and then they were fully open. During that period of time, they were able to still get the credits because their business was restricted. The way you can qualify for full or partial suspension is in order to determine how impactful this is on your business. It can't be nominal. It can't be something minor. Government order, you have to wear a face covering to enter my business. That's not good enough. There was something that impacted 2% of my revenue. I couldn't do something that I could have done before. Not good enough. The way the IRS is viewing this is not nominal, is over 10%. So if your dining room represents more than 10% of your sales in 2019, then you are going to qualify for the partial suspension test. There's also a nominal effect test if you don't qualify for the 10% revenue test. So the first test is you literally look at your gross receipts in 2019, you say my dining room represented 40% of my revenue for quarters 1, 2, 3, and 4. You're going to qualify for ERC the entire time until those restrictions are lifted because that revenue is more than 10%. For nominal effect, it has to be whether or not the government restricted your way of operating. And again, that still has to be more than 10%, but it doesn't tie back to revenue in the same way. Do you have a good example for nominal effect?
The example given in the notice had to do with spacing tables 6 feet apart. So it was a modification that a restaurant had to do that resulted in more than 10% of the business's ability to provide goods or services. It's a squishier test. It's not as well defined in the notices, but it's out there and it's not nothing.
No, and not every business is going to be able to track their gross receipts by type of business and how it was impacted. So not every law firm is going to be able to tell you what their percentage of revenue in 2019 was in Q2 for jury trials versus other types of trials or non-courtroom. Not every business is going to be able to track revenue that way. And if you're not able to do that, that's when you kind of want to look at that nominal effect. Okay, were these modifications more than nominal? Anyone have any questions about that before we go further?
Because that's really the big one as we've been out talking to law firms, they're saying, well, my gross receipts didn't go down, but partial suspension again, have nothing to do with gross receipts other
There
than
is a
your reference
question.
period.
Hang on. It's my understanding that Maryland law firms were an exception to this shutdown. So yes, when we talk about these partial suspensions, we are talking about essential businesses that part of their business was required to shut down or was restricted. So we should have said that earlier. So these are essential businesses. These are businesses that are open. These are not businesses that were totally shut down. So that's why there's a partial suspension test. Otherwise, it would just be a full suspension test. You are not allowed to open. You paid your people, you're going to get 70% of their wages refunded to you. But if you were allowed to, okay.
The various industries that are addressed in the notices are, medical providers, food establishments, grocery stores, manufacturers, all sorts of essential employees.
All these places were open, same as law firms. So it's just a matter of, did your business, was it restricted in some way because of COVID for a not nominal purpose? And Peter's about to go into some examples for you guys.
Oh, I'm doing this one.
Oh, I thought so. Is it wrong?
Yeah, it's fine. So the big thing here on eligible law firms is the Court of Appeals put out administrative orders that were affecting courtroom activities. That's really the big thing. So the Maryland judiciary was subject to restrictions from at least March 16th, 2020 through April 25th, 2021. There was a 5-phase reopening plan, and it bounced from 1 to 2 to 3 to 1 to 4 to 5. I mean, it was all over the place. So we're not here to say that all of you qualify all of the time. And the devil's going to be in the details, but some of you probably qualify some of the time. And the theory here is that the courtroom is your de facto workplace, and it affected, your gross receipt. I mean, a portion of your business that was more than nominal in 2019, and therefore you're eligible. Now, once restrictions are lifted, if it happens mid-quarter, I mean, you have to sort of dig into some of those issues, but those limitations that were in effect for even essential businesses is enough to qualify you for this credit. In addition to courtroom stuff, I mean, there's foreclosure moratoriums nationwide. I think in even more specific in some of the local jurisdictions as well. There's restrictions on civil, criminal, juvenile, family, landlord, tenant. I think the language used in some of the orders was problem-solving courts, which included drug courts and things of that nature. Jury trials were prohibited for a period. It was civil, it was criminal. I mean, you've got to take the time to go through, and we're happy to help, you work through some of these issues.
Or work with your CPA or whomever.
There's pages and pages of orders here.
And multiple notices.
Yeah, and there's a lot, but that's how attorneys are getting qualified for this credit.
So one thing that we didn't explain earlier that we should, and a question is raising it, is once you have a partial suspension for more than nominal impact or effect, your whole firm is going to qualify for the credit. It's not only the piece that is impacted by the suspension. So the restaurant whose dining room closed, all of the workers that are getting takeout, or like the waitresses, waiters, whoever, people answering the phone, your accountant, all the people that are on your payroll, your W-2 employees, all of those people are going to qualify for the credit. Once you're eligible, you're in. You don't need to nitpick and determine who did what.
Another important distinction is that each quarter is its own analysis. So you may have had a drop in gross receipts for one quarter. You always want to start with the gross receipts test because that's the most objective and the easiest way to qualify. So if in Q2 of 2020, you qualified based on a drop in gross receipts, use that one. We're going to talk about the third method here also, in a couple of slides. You can use that one, or if you need to use a partial shutdown. So the analysis, because you're using the Form 941 as your vehicle to claim this credit, is a quarter by quarter analysis. So moving on, just to make you guys aware, there is a third method to qualify for the employee retention credit. This is called a recovery startup business. By definition, you must have began operations after February 15th, 2020. So right off the bat, this is just telling you, hey, we're rewarding you for starting a business during the pandemic.
Worst time to start a business. Yeah.
Taking a risk.
We're sorry. Thanks for doing this. Please accept our apologies in the way of a credit.
Yep. So if any of you started your firms after February 15th, 2020, as long as your average gross receipts were less than $1 million, you qualify. Now, there is still a preference to qualify under method 1 or method 2, the gross receipts, the partial suspension. But if you don't qualify under those, you're eligible as a recovery startup business. Recovery startup businesses are only eligible, or you can only be a recovery startup business in Q3 and Q4 of 2021. In addition, and the Q4, you're the only category of eligible employer who can claim the credit in Q4 because that Infrastructure Act turned it off for methods 1 and 2. So it can be valuable. The only catch is that these credits are capped at $50,000 per quarter. So recovery startup business qualifying in Q3 and Q4 would be capped at $100,000.
If you qualify in 2020, let's say for 1 quarter with respect to 2019, do you get the credit for all the quarters in 2020, or just the one where you meet the 50% test? And the same question for 19 and 2021. If in the first quarter of 2021, your gross receipts are less than 80% of the gross receipts for the same quarter in 19, do you get the credit for the entire year, or just for that? Is it just for that 1 quarter?
So for 2020, if you have a 50% drop in Q2, and then in Q3, you have a 30% drop, you're still eligible. For 2020, the rule is you can't go over an 80% of what the gross receipts were. So you can have a 20% drop. So as long as you have less than or more than a 20% drop, you're eligible from that 50% point. So you can go quarters 2, do 50%. And then if you're 30% quarters 3 and 4, you're still going to qualify for all of those quarters. For 2021, you need a 20% drop in Q1, and then you automatically qualify for Q2, but you're not going to qualify for Q3 unless you also qualified for Q2. Sure, that's Q3. Very clear.
So basically, once you drop 50% until you pop back up, you remain qualified for 2020. But remember, 2020 is not the lucrative year. I mean, yeah. I'd take $5,000 per employee. That's fine. But 2021 is the big one because it's $7,000 per quarter. And then, again, they're making it easier and easier to qualify.
And one thing, and I'm not sure if we talked about this before, when we're talking about PPP and using ERC together, you can't double dip programs. So you can't use, like if I pay Peter $30,000 a year, we're not going to be able to max out on PPP and ERC because that's already $30,000 and it didn't start until March. So you need to really look at that and make sure you're not double dipping. So the way we do it at our firm is we do a worksheet or a work paper that has like all the wages paid from March 13th through December 31. And then you'll be able to see PPP wages, ERC wages, FFCRA wages, all that kind of stuff. You can use the programs together, but you can't use the same wage twice. If that makes sense. Just something to be thoughtful about when you're looking at all these things and eligibility and credits, and you have to also back out all of those prior government programs.
So if you maxed out on PPP in both PPP1 and PPP2, you got paid the maximum amount that you could be paid for your employees. The ERC is unavailable to you?
Alan, thank you. So you can get all the programs, you just can't use the same wage. So if I make $200,000 a year, I got $20,000 of PPP. You're giving me $10,000 for 2020. PPP, that's all good. 2021, I got $20,000 of PPP and I can get $30,000 of ERC. There's still lots of money left that are not government funded. You're really only going to have an issue in 2021 for anyone that makes less than like 60, I guess. But it's all going to depend on how much wages they make. And there's other expenses you can include in gross receipts. In wages that we'll get to, like health expenses and tips and stuff like that.
Is the test for method 2 just for, is the test for method 2 what you outlined on the partial suspension for the courts, or if clients stop referring cases because they were closed, can you use that as part of the partial suspension test as well?
So the notices make it clear that a reduction in demand for your goods or services is not enough. Beyond that, there is an idea that supply chain issues could affect businesses downstream. The notice itself talks about goods. So the idea that you need a part to make your widget is really the example that is provided. But at the end of the day, the most important thing to remember for either you or your clients is that it has to go back to a government order that's specifically limiting commerce, travel, or group meetings due to COVID-19.
There's a lot of supply chain issues right now that are dealing with because of like vessels and stuff like that, it's not related to COVID. Like it's all related to the pandemic, but it's not related to, New York State saying we're not taking X widgets coming through the gate. And so you just have to be careful to make sure that it's tied back.
All right, so let's dig into a couple details now. The question is, okay, well, what are the qualified wages? And the big rule that they came out with was in 2020 and 2021, it was important how many full-time employees worked for you. So in 2020, if you had more than 100 employees that worked for you, you were only eligible for ERC because it was only a qualified wage if you paid the workers to sit at home, okay? You had to be paying them not to work. If you were under 100 full-time employees, you could pay them for any reason. This last bullet point, there's a disagreement between the IRS and the Joint Committee on Taxation about whether full-time equivalent employees must be considered in the full-time employees. The IRS has been very clear, and they doubled down in successive notices that said, we only consider full-time employees, and what that means is 30 hours per week or 130 hours per month. Joint Committee on Taxation came out with something summarizing the legislation and said, we think the full-time equivalent comp is important. I think there's enough out there that you could rely on the IRS's guidance, but that's the 2020 rule. Following the general trend that they're making this stuff easier for everybody, they bumped that up to 500 for 2021. So as long as you were under 500 employees, you could be paying those employees to work or not to work. If you were over 500, you had to be paying them to stay at home. This is you, Rebecca.
I can't read the page numbers. Limitations and refunds. Wages taken into account. So The amount of qualified wages credited by the eligible employer for any calendar quarter shall not exceed $10,000. Recovery startup businesses. In the case of an eligible employer, which is defined as a recovery startup business, the amount of the credit allowed under any calendar quarter shall not exceed $50,000. So if you started a firm on February 18th, 2020, and you have 2 associates, a paralegal, and a receptionist, you qualify under recovery startup business. So what that means is that you still need the wages to get to that $50,000, to get to that max credit. It's a ceiling, but it's not an automatic. So you can start a business that has $5,000 in wages, and you're not going to hit that $50,000 mark. So that's the top that you can do for those types of businesses. I'll get to your question in 2 seconds. So refunds of excess credit. How are you going to get paid? The amount of the credit exceeds the limitations set forth for any calendar quarter. The excess shall be treated as an overpayment that shall be refunded. You get a check. This is like one of the biggest questions we get all the time. They're like, oh, do I get like a carry forward credit for like the next 20 years of payroll taxes? No, you get a check in the mail. It might be a little while before you get it, but it's actual cash from the government that you're able to get and able to use in your business. However you want, there are no limitations. I got this question a lot too. It's not PPP. It's not Restaurant Revitalization Fund or EIDL money. It's money that is a refund that you get to use. You can take it as income. You can use it to build a new wing on your building. You can do it with it whatever you please. All right.
Just to answer a couple quick questions. Yes, the reference period for the employee count it's an average. The average number of employees you had during 2019. It's not 2020 or 2021. If you had full-time employees with their hours reduced, yeah, you still qualify. It's not the same situation of PPP. The reference period is 2019.
And again, these are capped. So you have to have you only need to worry about this if you have 102 employees and a couple of them aren't full-time. You don't need to worry about this if you've got 38 full-time employees and 15, part-time employees. And again, like Peter said, 2020 is nice, but the larger credit is in 2021, and that max is 500. So you would really have to have a lot of people in order to even, be concerned about this kind of calculation. If you're looking at it for your clients, it's something to keep in mind, but most people here, I think, would be okay.
Rebecca, on the first bullet point, the amount of qualified wages shall not exceed $10,000. Is that per employee?
Per employee.
Thank you.
Yep. So again, it's 50% of up to $10,000 per employee for 2020, $5,000, 70% of up to $10,000 per quarter in 2021. So $7,000 per quarter. So $21,000 per employee for 2021 and $5,000 for 2020. Next slide. Assuming this is still me, impact of other credit and relief provisions. The employer's ability to claim the employee retention credit is impacted by other credit and relief provisions. So this is what we were talking about before. I obviously remember there was a slide about it. I just really wanted to talk about it earlier. So if the employer received a small business interruption loan under the Paycheck Protection Program, authorized under the CARES Act, you just can't, again, like what I said before. So you got PPP, you got FFCRA, you're looking at the CARES Act, you're doing all the things that you need to do. You have a client that got RRF money, you're getting an EIDL loan, what are you able to do? You're still able to get the employee retention credit. You're just not able to double count the wages. So there are times where that makes a big difference, and there are times that it doesn't. Now, we'll get into this, but the employee retention credit is not eligible for owner employees or family members of owners and things like that. So there's ways to kind of push PPP money to those people who qualify for PPP and have more of an ability to get you have less PPP wages on other employees. Again, this is something that you'd want to work with your tax professional or whoever's helping you to make sure that you have proper documentation in your file And I think a work paper is really what's best there to show exactly where the dollars went, so you don't have any questions. I swear I can't see the page numbers. Can anyone else see a page number? How to claim the employee retention credit. Going to go on your form 941. This form pretty much sucked before the pandemic, and now it's like 3 pages long, and it's awful. It costs so much less. When we talk to CPAs, we have like all the forms and stuff. We're not going to bore you guys with that stuff, but we'll show you the actual worksheet you have to use. But eligible employers, there it is. And then, so this is just the worksheet that you use to prepare the form that's going to be in your file. That is 3 pages long, to make sure that you're doing everything properly. At this point, there's like a section that's like a carry forward credit and a section that's a refundable credit. Everything now is going to be on an amended form because it's all past the point of when you were eligible for it. So it's all going to go into, it's all going to be refundable, even if it's under a carry forward provision, if that makes sense. There's the next slide.
All right, so fun times. With PPP, everybody was asking us, what do we need? What's the bank going to ask for? If we get audited, what is SBA going to ask for? And we said, I don't know. They haven't told us. In the CARES Act, in some of the subsequent language, they actually delegated authority to the Treasury Secretary to come out with some of this stuff. So they've actually said, you know, here's the substantiation that you have to come up with. So you need to go and find the government order or ordinance that caused the shutdown or partial shutdown. For those of you on the webinar, I mean, it's going to be the administrative orders from the Court of Appeals. If you qualify based on gross receipts, you need records to show the decline in gross revenue. You also need to be able to identify what you're considering the qualified wages for the purpose of the ERC. That's what Rebecca's talking about when she's talking about a work paper showing what's going to PPP, what's going to FFCRA, and what's going to ERC. For the large employers, over 100 employees in 2020 or over 500 employees in 2021, you need to be able to show that you were paying folks to stay home. To the extent that you are including health plan expenses in qualified wages, you need to be able to show the health plan expenses. Those plans it's basically premiums that you're paying on a pre-tax basis for employees' healthcare. That's not the big number here that's going to, you know, get you to a really big credit, but what we've seen is it's adding 5% or so. So if you do realize that you're not maxed out, it's probably worth the time to go back and pull those health plan expenses.
And if you represent any restaurants or bars or any place where like tips have added a lot to clients, especially when they got big PPPs, the tips really helped, you know, add to that ERC.
Yep. And then we'll get into it a little bit in the next slide, but there are aggregation rules. So if you're a group employer, you may have more information that you need to capture. Form 7200 referenced here was an advance payment of the ERC. That's not relevant anymore. And then of course, copies of the form 941 that you actually claimed the credit on. Again, because all of you are in perfect tax compliance, you've already filed your 941. And so these are all going to be 941-X's that you're going to be filing. Retain the documents for at least 5 years, and we'll talk about that next. So there are
really quick. So the way we're doing this for firms where we're dealing with partial suspension and suspension, like I said, we do like a PPP work paper or any other, you know, bucket of credits work paper to show where the wages go. We're also doing like memorandums to show how the ordinance actually like impacted and include facts and things like that. Try to do something like that if you can. All of you can write legal memorandums, I'm sure. I have no doubts about that, but definitely like while it's fresh and you've got the information in front of you, put it together. And then if the IRS does knock on your door in 4 years, you have a really nice file and say, I filed these 3 forms. This is my information. I did this, I had jury trials of 40%. This is where I kind of came to, that kind of thing. And I think that will really help bolster your file for if there's ever an issue.
Yep. So there are just some special issues that we want to address because there is a somewhat of a catch on these.
Everyone always asks what the catch is. This is the catch.
Yeah, this is the catch. So I said earlier, this is built on existing IRS law, Internal Revenue Code. So there's reference in the CARES Act, as it's been amended, to aggregation rules that apply. So Section 52, 414, 1563, these things where they're capturing parent-children situations or brother-sister entities. If you've got someone involved in the business who has an interest in other businesses, you need to slow down. You need to line out, okay, what's their ownership position in this entity? What is it in these other ones? Because you may be having to grab gross receipts from some of the other related entities. You may be having to grab employee counts from some of the other entities. So if there's a situation of multiple owners and those owners have interest in other businesses, you need to work through that as well. If you are an owner of more than 50%, there are certain relationships, family relationships, that make those other individuals deemed owners. In that situation, it doesn't make you ineligible for ERC, but it means that their wages can't qualify as a qualified wage. So you wouldn't be able to use that, maximum $10,000 and therefore claim a $5,000 or $7,000 credit based on that. There are specific rules when you acquire a business during 2020, 2021 that, again, if that's part of the fact pattern, you need to work through. Owner employees of S Corps, if they are more than 50% owners, their wages are not qualified. Again, it doesn't mean that if you, and this is a question that just popped up, I'm not just bouncing around. It doesn't mean that you're disqualified for the entire credit. You could have employees that you're paying through an S Corp. Or if you're not a more than 50% owner, you may still be able to use those qualified wages. Sole proprietor income is not considered a qualified wage. So this is a little bit different than PPP. So PPP, you had folks who were sole proprietors filing on Schedule C, and the name of the game for that was, hey, what's your line 31 net business income? And you can use that to get your PPP loan. This is specific to wage. Wage is paid on or reported on the W-2. You file your 941s. You're having taxes withheld. Again, this is built on 941 employment taxes and wages alone. Then in the same breath, they said, well, maybe not, because household employers are not eligible. So if you have a nanny at home taking care of the kids, you can't claim that person's wages based on or qualify for ERC. The big ones are these last 2 bullets. Generally, the IRS has 3 years to come back and audit something that you've got going on in a tax return. The CARES Act specifically increases the assessment statute of limitations to 5 years for this. So government realizes that this is a lucrative program. They're going to come back and they're going to do audits of these returns, and they just have an extra 2 years. What they didn't do, grab the substantiation stuff, do it while it's fresh. Rebecca's right. Last bullet point: they didn't increase the refund statute, so they get 5 years, but you still only have 3. Each quarter for these 941s has its own refund statute. So I've got here July 31st, 2023. That's because the Q2 2020 Form 941 was due July 31st, 2020, plus 3 years. Each quarter has its own, so they're gonna roll off, but that's the first statute. So you've got a little bit of time to figure out if you qualify and get these filed. That said, these things are going nowhere fast. The IRS is in shambles, and I think 7 to 9 months is what it's taking to process these claims.
You want to get in queue when you can. Yeah.
Last I saw, they were 9.5 million employment tax returns behind, and 20 plus million overall, I think is what the stat I saw. But these are sort of the catch issues. There is one more big one.
Yeah.
And that is the tax treatment of ERC. So again, this is using existing law. Code section 2080C says that if you get a credit based on wages paid, you don't also get to claim the wages paid on your tax return. The problem here is that for some folks, by the time they even realized that ERC was going to be eligible, they had already filed a tax return. And so you probably need to go back and amend your 2020 tax return and take note of what you're doing based on 2021 if you haven't filed, already. But it goes beyond just the business tax returns. Depending on the structure, if you've got a partnership, if you've got an S corp, and these are flowing through, you're in a situation where you're filing new 1065, 1120S, but then that's going to affect the K1s. You're going to have to send amended K1s to the partners, to the shareholders, and they're going to have to amend their 1040. That said,
it's still a good deal.
Still a good deal.
People are like, oh, well, if I have to pay taxes on it, I don't want to bother. We're like, no, you should.
It's still a good deal because it's a refundable credit. You're getting cash back in the numbers have been really big on some of these things.
We have clients that have gotten over $1 million. Well, are in queue to receive over $1 million. In a few months, they should start coming in. But we have clients that have really benefited from this program, which is great. I mean, there's restaurants and bars that I represent that have been able to stay in business because of this stuff, where they would have been decimated otherwise. Other businesses, like people that run kids programs and things like that have been impacted. We have law firms as clients. We've got, government contractors. Like there's so many people that are eligible, and it's just a lot of money out there that can help you.
There was a question that came in. So this doesn't apply to part-time employees at all. Wages paid to part-time employees can still qualify as qualified wages. So I think the answer to your question is no. I don't know if you're getting into the nuance of, and feel free to unmute yourself and we can flush out the idea. But the question is, does a part-time employee affect the employee count in 2019 that may affect whether something's considered a qualified wage?
It's probably fine.
A bit of an open question, but the IRS has said no, and Joint Committee on Taxation has said yes.
I mean, that's only if you have 100. So like if you've got 30 people or 5 people and 2 are part-time, you're still going to be able to get their part-time wage. It was just an eligibility threshold issue. It's not about how much money your credit is. Once you're eligible, this is the same as the partial suspension, right? Once you're eligible, you're in the program, you're in the door, you get all the things. You don't have to parse out each employee, and she was part-time for October, but went up to full-time in November. Like none of that matters. It's just eligibility. Anyone else have any other questions? And we're around, we're happy to help. If you've got questions that you want to talk to after, you can certainly reach out to us. Peter and I kind of joined through the short straw in our firm. And so we are way up to date on all of this stuff, PPP, EIDL, ERC. And we just, we're happy to answer questions rather than have you guys digging for hours that we can answer in a couple of minutes.
And 5 years from now, this will be nothing.
We are no longer going to be ERC lawyers in 5 years, but for now, we still are. So we're happy to help you while we're still like in the middle of all this.